were talking about that initially Indian rupee was partially convertible and then it later became the fully convertible with its increased access to the financial markets, infusing more of liquidity, and that is what has been the purpose of RBI also, that it does want to infuse the liquidity into the financial markets. That is why those open market operations of introducing those traditional instruments or the modern instruments with respect to your forward swaps or your futures, so that was done so that it can increase the liquidity into the financial markets, and also they improve the employment or business opportunities, or they can also sort of create the easier access to the capital market. Then there are also some of the disadvantages. It's not like always very rosy picture out of the same, but there are some you could say challenges of a fully convertible currency also, that there remains in certainly a higher volatility, and then there will be a major effect onto the balance of trade and exports also because of a fully convertible currency, or similarly there can be an increased burden of the foreign debt. So these are some of the apprehensions which at times being felt by various economists when we talk about a fully convertible currency, right. So when we see that India has traversed a journey from fixed to a point when pegged against single currency, to a point when it was dealing, to a point when we adopted the lumps, which is a dual mechanism, to a point when we go for fuller convertibility, and that fuller convertibility is for current account transactions. So there was a recommendation by the committees onto the capital account convertibility, and that was presented in 1997, which talks about the Tarapur committee recommendations on capital account convertibility. Though the currency is fully convertible, but it was not convertible with respect to capital account, right. It was only convertible with respect to current account transactions. So a committee on capital account convertibility was set up by the Reserve Bank of India under the chairmanship of S.S. Tarapur. So what was the the intent or the vision of the committee is that they want to lay down a map for your capital account convertibility, to come up with the recommendations onto the same, that okay, this being the preconditions in case the currency has to go for capital account convertibility. So they talk about the preconditions, they talk about what are mandated guidelines in order to move towards a system, to a mechanism where we talk about capital account convertibility. So the three crucial preconditions were fiscal consolidation, which is a mandated inflation target. Again, there should be fiscal consolidation, which is sort of a mandated inflation target, and strengthening of the financial system. So these were said part of your preconditions when we talk about capital account convertibility. So for the same, a 5-member committee was formed, and that 5-member committee has recommended that this is the time period that for the a 3-year time period will be there for complete convertibility, and by 99-2000, because this report was there in 97, this was presented, right. So in 99-2000, by 2000 they expected that during this 3-year time period there will be fuller account convertibility with respect to capital transactions. So what being the highlights of this, including those preconditions that are required for the full float, or in a sense fully convertibility floating mechanism. Float here means a floating mechanism, right. So for the money, so it says that RBI should have a monitoring exchange rate band of 5%, which should revolve around the real effective exchange rate, and RBI should intervene only when your real exchange rate, effective exchange rate, is outside the band. So it says that it should have what? It should have a monitoring band, rate band rakho, which should be around 5% of your REIT, and if it is exceeding that range, then only RBI should intervene, number one. Number two, they say the size of the current account deficit should be within manageable limits, and the debt ratio should gradually reduce from a 25% at that time to the 20% of the export earning. So, they talk about that there should be a decline in the current account deficit, and that current account deficit should be within those manageable limits, and so does your debt service ratio should reduce, because they at that time it was staggering around 25% of the export earnings. So, that should fall to 20% of the export earnings. So, these were like a few of the recommendations that RBI, that Tarapur committee put forward. Then it says that in order to meet the import and debt service payments, the forex reserves, they need to be very adequate, and they should be set between this range of USD 22 billion to USD 32 billion, right. That means the government should sort of remove all the restrictions, that being your fourth condition also, that says all your restrictions on the gold movement should be removed. All those quantitative impediments on the movement of gold should not be should be removed totally, and for that to do what is that you need to maintain a forex reserves between this range of your 22 billion USD to 32 billion USD. These were the recommendations, and these recommendations were proposed so as to achieve the fuller account convertibility with respect to capital transactions. So, these were the majorly 4 recommendations, including those three preconditions that says that these are the things that suffice the requirement for capital account convertibility. Now, this were the first first committee, not the meeting, but the first committee recommendation under the chairmanship of S.S. Tarapur. There is the second Tarapur committee also, because for the second account, since it was not attained in the first one, so RBI did what is, it appointed the second Tarapur committee, so that a fuller capital account convertibility is now attained. So, committee again was established by your RBI so as to revisit this fuller capital account convertibility wala proposition, and in sense is that that fuller account capital convertibility should be such that it goes with the vision of economic reforms, one of the major economic reforms, but it also goes for the stability of your external and financial accelerated growth or global integration, right. So, the report was again floated on, the recommendation were made up on 2006, and then again this gives a roadmap that by 2011 will be as the target date for achieving the convertibility of rupee. So, that was set out in 2006 time period. Okay, next coming 5 years we will be able to attain the convertibility of the rupee with respect to capital account transactions. So, again the committee made some recommendations. The recommendations were in the form that okay, the ceiling for ECB, that is your external commercial borrowings, it should be raised, and not just raised but also the manner for which the approval is required, it should not involve much of complexities, rather it should be a very automatic approval for the in order to raise that thing, that ECB, that approval should come very automatically. We need not to have much of procedures or complexities for the same, rather it should be very smooth activity, right. And then the NRI should be allowed to invest in the capital markets. That's the second recommendation, apart from the additional that they had in the previous one. So, they said that now the NRIs, they should be allowed to invest into the capital markets also. Plus, they say that NRI deposits not just should be they should be allowed in capital markets, but they should also be given some tax incentives, in form of tax benefits. So, those tax incentives should be provided to them, those benefits should be provided to them, and through that, again it is going towards that, it will proposing for improvement in banking regulations, that better regulation structure should be there, and the structure should be such that initially what was like these NRI deposits, they were not promoted in a sense as that we are not allowing for extra benefits, any sort of benefits to these NRI deposits. So, these were the recommendations of this Tharapur committee, which talks about that now we need to have such recommendations into the committee, and we need to abide by the same, so that we attain that fuller account capital convertibility. Then it says improvement in banking regulation should be there, and additionally foreign institutional investors, they should be stopped, they should be prohibited from investing fresh money raised to participatory notes. So, participatory notes, when we talk about, so those participatory notes regarding we are putting a sort of restrictions onto the same, that they should be stopped from investing their money towards the P notes, right. Similarly, existing P note holders should be given an option that they can take an exit route to completely phase out their PN notes and promissory notes, or the and that option should be given to those holders, that they can choose for that exit route also. So, these two set of your policy recommendations were proposed, so that you attain not just fuller account or flexibility in the exchange rate system, but also with respect to your capital transaction, not just restricted to current account, but capital account transactions. Some of the recommendations were totally taken into consideration, some were revisited, so as to delineate a structure whether it is feasible in the market, and we have to see from multiple angles whether there being a feasibility of these recommendations, and whether we will be able to achieve the set a target, or what would happen if we will allow for a fuller account capital convertibility, will there be major disruptions into the market or not. So, that is why it generally takes a lot to work upon these recommendations. It is not like a simple recommendation, a submission and an action could be taken in a day or two. Obviously, it requires time, because it is a thoughtful process. You have to see it from the point of view that what could be the repercussions of the same, or the impact of the same onto the market, how would the domestic market would take it up, how would the foreign market would take it up, what will be the impact onto the foreign exchange market, what will be the impact onto the forex reserves, what will be the impact on your financial market. So, each and every action of yours is actually it impacts a lot, it creates a major impact onto the market. So, talking about, summarizing on to what we talked about today, is we talked about the exchange rate management system in India. We talked about how we had a fixed structure, how we moved on to a structure which is in tandem with the Bretton Woods guidelines, and then to a structure where currency was pegged against single currency, devalued or de-linked, rather we couldn't say, it was de-linked, and then again we opted for a floating structure, but a floating structure in a sense is flexible structure, that initially we opted for a LOMS for a period of 92-93, wherein we opted for this option of 60:40 ratio, that okay, 60% be decided by your market forces and 40% be taken up by your official routes. And then we talked about that how we move towards fuller account convertibility, and after that transition phase of your loans, and in fuller account convertibility we only attain current account convertibility, not the capital account convertibility, and that is why there were recommendations onto the same by the Tharapur under the chairmanship of your Tharapur, SS Tharapur, and that committee was institutionalized by RBI, right, so as to govern the major structures or to provide the policy decisions onto the same. Now, when we say that this exchange rate management system, so the present structure we see around is very smooth. It's again there is a compliance thing which is actually very crucial given the situation, because again there will be otherwise money laundering, otherwise there would be an act of tax evasion or avoidance. So that is why the government keeps a tap onto the same. It keeps some upper thresholds, it keeps some cappings onto the same, and presently we see that we see it very smooth if we want to just convert a currency into some other denomination. And nowadays also that maybe the day would come soon that when we'll be easily able to use the UPI for making a transaction in any part of the world. So obviously for that a number of committees being formed for the same. It is still under the works. The thing is is such that the work is taking place, it is in progress, and with the time we see that there is much more smooth flexibility with respect to exchanging the currency. Earlier we used to see we need to pay a good amount onto the commission to exchange the currency, but presently the structure is such integrated and also easy with respect to digitalization. You can say that you need not to rush to some agency to convert your money, or to need not to rush to some XYZ place so that you convert your currency into some other denomination. Rather what you can do is that you can right away through your cell phone logging into a number of different applications, simply punch in your details, complete the basic document verification, and can easily get your money converted into foreign exchange. And similarly the remittances has been very smooth now. Earlier if you remember that it takes a longer period of time to send the remittances or to receive them, right? And with the period of time, with the passage of time, that remittances can now be done within few minutes. You need to do what is, you need to have that for net banking where these foreign operations are activated without paying any extra bucks for the same, and you can just add a beneficiary with all those codes, those routing numbers, those SWIFT code given to you by the beneficiary, or add them up and simply have the funds that are required to run the transaction. And within a time period you would see that that transaction gets completed. It just takes maybe just fraction of seconds or a few couple of minutes to run a transaction. So that ways it becomes simple, smooth over the time period that a banking transaction similar to a normal net banking transaction, it is made very easier, very convenient for the person to go for the foreign remittances, right? So imagine you sitting at your place can easily run a remittances transaction, and you need not to rush to any banks, you need not to rush to any agency. It is made super easy. All those cumbersome procedures have been eliminated, all those manual compliances being eliminated. Rather there is digitalization, rather there is much more smooth, more swift activity towards that. And the government is taking a lot of initiatives towards that direction so as to provide much more ease, because today's world is an digital era, an integrated era, where number of businesses or even per se any individual running any transaction, any foreign transaction should have that ease that just by sitting at your place of convenience you can run a transaction. All you needed is a system and an active internet connection, and you can simply run a transaction within just couple of minutes, right? And also the processing time, which earlier is somehow straggling around 2 to 3 days, is now somehow reduced to a time period of 1 to 2 days. So within 24 hours the transaction gets processed. So that much super easy. and again the timely information of each and every step, so that you can get a track of the situation. So that's what being done by the government over the time period. So government is very proactively engaged towards these things. Government is actually taking this digitalization, and we market, we are among those emerging economies who are taking digitalization on a serious note. We are rather we are a leading one when it comes to digital payments, right? And for that we do have the relevant infrastructure and resources, and rather the over this past decade there has been a major jump in the number of digital payments, in the number of digital transactions, and making these foreign remittances through these digital mechanisms. Now it has become super easy. Now you can get it. Obviously the the checks are there. The checks are there so as to save the people, the business houses from any sort of scams or frauds. So that is why there is a check on to for every transaction. It do get verified by the banks or the authorized agencies when you are routing through them. So that ways we can say now we see a very smooth structure. So it took a very long journey to reach out to this point where we are presently, where the structure is so much super smooth, where it is very easy to get your currency converted. So it is, that is why we say that it has been a journey. It has been a pure journey where number of efforts have been taken over the time period to reach to this present time, where we are totally almost digitalized with respect to our operations, and also for the same, so as to keep a tap onto that it doesn't lead to tax evasion also, tax avoidance also. So government does what is, it keeps an upper capping that during a financial year, if your remittance is exceeding per se 7 lakhs limit, so you have to make a declaration of the same, that and your TCS will be deducted onto the same, so that taxes which are being paid by the abiding citizens, that should not get wasted, that should not get you could say being evaded by someone. So those through those taxes, a framework, a mechanism, a sort of structure is created through which the government is ensuring that yes, we do have stringent compliance mechanism, so that we can keep a tap onto that nobody can escape those taxes, and the transactions get recorded, and there should be a bureau of each and every transaction that takes place. So you can also monitor whenever you are running a transaction that okay, these are the transactions that you had during the previous year with respect to foreign transactions, or or the remittances that you received, and that's been very easier now. So that's what is the motto of, or the intent of saying it, that okay, this exchange rate system, this after going through a journey, it has reached to a point where we are talking about digitalization. Whether we are leading in terms of digitalization, we are making it super easy for our people, for our business houses, for those SMEs, if they are entering into those international transactions, that foreign exchange management or the convertibility should not be a hassle. It should not be an impediment in this journey of integrating them with the globe. So it makes the entire system very robust, a very holistic approach being taken up for the same, and it ensures the benefit gets passed on to down the line, and the small handicraft segment or any other sector, SMEs or small scale enterprises or micro enterprises, MSMEs, right, they are also benefited from the same with respect to your ease in you could say convertibility when running a transaction for both sending and receiving the amount, right. So, that ways the operations, the time period, everything is made super easier, super convenient to the people, that anyone can through those banking operations can run a transaction or can receive the amount, right. There are authorized agencies also by who does involve into these foreign exchange services, who provide those dedicated services with respect to convertibility, with respect to selling out any currency, or you want to buy some foreign currency. So, both ways buying and selling operations made super easier. Sometimes they do offer those EMI options. So, that sort of flexibility, that sort of ease is provided into the Indian market for the for the both the domestic sectors and you could say, so that they can have a super smooth international and you could say transaction when running for a foreign trade transaction. So, those recommendations about those capital account convertibility that are also being taken up by the government on a right note. How can we attain that capital account convertibility and fuller capital account convertibility. Obviously, again as I said that there are things associated with the same when we say that we attain convertibility in current account and in capital account. So, both have different versions. So, capital account means that you running a transaction for a long run investment. So, that should be for that also the rupee should be easily be converted into, right. So, that sort of ease is being provided by the government over the time period, and also additionally not just this, the government is also doing what is it is through those this present foreign trade policy which is effective since 23. It is trying to come up with better mechanisms or procedures to make this structure more integrated, to make this structure more elusive in a sense is that its applicability becomes very easier, and we can say that through this not just for this term but for also foreign trade policy. When we talk about it is with respect to your with respect to the benefits, rather I would say, or the incentives that being given to the people at large, so that this foreign trade is promoted. So, whether coming up with better banking regulations or coming up with the policies for foreign investors, or coming up with something where we are providing for the automatic approval to say for the deposit schemes or to investment into the financial market. So, through that FTP the government is coming in tandem with providing an atmosphere to the people where they get an enabling environment to trade easily, right. So, exchange rate management system, which is most important part of the same. So, that is why in understanding of the same is very critical. Had you have any doubts with respect to the same, with respect to the norms or exchange rate management system, you can inbox your queries and I will try to get back to the same, right. And this is very crucial to understand that norms also, which is transitory phase, had a very crucial role to play to move to this present time period where we are having a very fuller convertible zone. So, this is all for the exchange rate management system. We will be coming up with more interesting topics on foreign trade in the coming sessions. So, thank you.